What if the biggest risk in your real estate deal isn't the interest rate, but the loan term? After watching what happened with interest rates after COVID, the importance of debt structure became impossible to ignore. Short-term loans can make you look smart in a hot market and bankrupt in a cold one. Inflation can actually work for you if your debt is fixed in long term. Welcome to Strategy Saturday. I'm Charles Crillo, and today we're breaking down how long-term debt protects your returns. Most investors focus on just interest rates, but the structure of your debt can matter just as much. So let's get started. While many real estate investors mainly focus on interest rates alone when getting a mortgage, the structure of your debt can matter just as much and sometimes even more. Long-term debt lengthens your property's runway. And the longer it is, the lower the investor's risk exposure usually is. And this happens for a few reasons. Number one is the interest rate protection. So interest rate volatility is one of the greatest risks real estate investors, especially commercial real estate investors, will face. Many investors take out short-term loans, such as a bridge or hard money loans, to close on a property quickly with lower down payments, which puts the investor in a position to reposition the property quickly and hopefully resell or refinance it once the value has increased. Now, the problem is that a 1 to 3 year loan is not much time to weather renovation delays or wait out an economic pullback. And if interest rates have increased, the whole deal may go south as it did in 2022 and 2023 for so many deals. Now, having long-term debt, usually with a higher interest rate and a higher down payment requirement, gives investors ample time to complete their business plan without having to make renovations that might not be practical during a down market. Number two is principal paydown. So many short-term real estate loans are interest only, while most long-term loans feature interest and principal paydown. So as you pay your mortgage, your equity increases, your net worth increases, and your loan to value decreases. The lower your leverage, the lower the investor's risk exposure is in a property. Now, this allows for more flexibility, and if you need a chunk of cash in the future, simply refinance the property or add a second mortgage, since one thing that all lenders like is a property with a lot of equity to lend against. Number three is inflation hedging. So as you pay down your mortgage, you are paying the bank back with dollars that are cheaper than when you borrowed. So as inflation increases, and as your property value increases, your loan to value decreases. This puts the owner in a safer position every time they make a mortgage payment, and with every payment, they are paying the bank with cheaper dollars. The real benefit of fixed long-term debt is that if you own a property and inflation spikes, inflation is pretty much eroding your debt. Number four is avoids required refinancing or sale. So you never want to be forced to sell or refinance a property. Long-term fixed rate debt gives the investor a long runway in which 7, 10, 12, or more years down the road, the net operating income and property value will grow and offset any market headwinds when they refinance. Now, the investor also avoids expensive refinancing hassles and fees that can add up quickly. Number five is consistency. With fixed long-term debt, the monthly interest and principal payments remain fixed for the life of the loan, providing stability for the investor. There is no need to worry about current interest rate fluctuations or worse, having to predict where interest rates will be in 2 years. Consistency is one thing that passive investors look for in a deal, and offering that will make your project more attractive. Long-term fixed rate debt isn't about maximizing returns, it's about protecting returns. If you purchase a property that cash flows with long-term debt while having ample reserves, it makes it really hard to lose money. And if you want to learn how to reduce your real estate debt with inflation, you can check out episode SS47. That's SS47. So I hope you enjoyed. Please remember to rate, review, subscribe. Submit comments on potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.